Thank you very much, Jorge. And you've done a brilliant job organizing this event over the last few days. And I can honestly say, for these last few days, there's nowhere else in the world I would have rather been than here in Cartagena. So it's been a brilliant set of seminars. So today what I'm going to talk about is some of the financial instability that we've seen over the last few months and how this is really rooted systemically in our current banking and monetary system. And just as a very quick introduction then, so I run the Cobden Centre, a think tank in Britain. It was founded by a member of parliament called Steve Baker. And last year we wrote a book together, essentially looking at the last generation or so of policies from central banks and the consequences, specifically making the case that for more or less the last generation, central banks have responded to each recession in much of the developed world by creating larger and larger debt bubbles. But then also at the Cobden Centre, we've done quite a lot of seminars on these topics, including at the Bank of England, at the OECD headquarters, and in the European Parliament, among other institutions. So we've had a lot of feedback also from establishment thinkers as well. So today I'm going to touch on two key issues. The first one is the current monetary and banking system and how it works, which many people find quite surprising. And the second part is going to be the consequences of this and how it's led to a lot of the instability that we're seeing at the moment and why that's going to continue and in fact get worse. So first off then, the current monetary and banking system. So for those of you who have studied economics, you'll be aware that in most economics textbooks, what they teach is essentially that what banks do is they take money from depositors and they then lend that money out to borrowers. So Bob comes into a bank, he deposits $10,000, the bank leaves, let's say, 10% of that in reserves, and it lends out the other $9,000 to borrowers. For sake of argument, it might pay 3% interest to Bob, and it may take 6% interest from the borrowers. And that, in essence, is how banking is described in almost all macroeconomics textbooks. But unfortunately, that's actually incorrect. So really across basically the whole developed world now, the way that modern banking works is that when a bank makes a loan, it creates that new money out of thin air. It creates that money out of nothing. So for instance, if you go to a bank and you want a mortgage, if you want, let's say in the UK, £500,000 mortgage to buy a house, the bank does not just pull that out of its reserves somewhere, out of deposits. It creates that £500,000 out of thin air. So if you're familiar with basic accounting and balance sheet operations, for you as the borrower, both sides of your balance sheet have been expanded. So you have both an asset of the £500,000, but you also have a liability in terms of the debt that you owe to the bank. But also the bank expands both sides of its balance sheet, both the asset side and the liability side. It does not move that £500,000 from somewhere on its balance sheet in the form of deposits. That new money is simply created out of thin air on the spot just by typing the £500,000 into a computer. Now, I've had many people that I've explained this to, including very senior people in banking and even central banking, who have been very skeptical about this. So over the years at the Cobden Centre, we've interviewed people right at the top of the pyramid who have confirmed this. So two particular examples. A few years ago, I interviewed William White, who was the chief economist at the Bank for International Settlements. So that's the central bank of central banks. They're based in Basel. So if you've heard of the Basel regulations, that's where they all originate. And he in fact confirmed that yes, the economics textbooks have it wrong. Banks do not lend out depositors money as it's taught. Banks in fact, when they make a loan, they simply create that money out of thin air on the spot. I also interviewed Lord Adair Turner, who was the chief financial regulator in Britain and who also worked in Basel as well. And he confirmed the same thing. He said, yes, that is indeed the case. Regardless of what the economics textbooks teach, banks simply create that new money by entering those numbers into a computer. Now, for those of you who are new to this, you may well be thinking, are there some ethical issues involved here? And indeed, there are. So let's, again, think about the mortgage example for a minute. So you go to a bank, you want a mortgage of £500,000 to buy a house. The bank enters those numbers into a computer. £500,000 of new money is created, which is then lent to you in the form of a mortgage. You then, of course, spend the next 30 years of your life working 5 or 6 days a week, paying interest on this money that the bank simply created out of nothing, and of course, paying down the principal. But in addition to that, what happens if you fall on hard times? If you happen to lose your job, for instance, the bank will then take your house from you, sell your house, keep the proceeds, and you get nothing. And this is all on money that the bank simply created out of nothing when it issued that mortgage. Now, for those of us who understand this process of money creation, there are still some disagreements on technicalities. For instance, one of them is the extent to which banks are constrained in how much money they can create. So some people who even those who understand this money creation process, say that banks are constrained, they're what you call in the literature reserve constrained, by how much reserves are held at a central bank. But in fact, the Bank of England wrote a paper a few years ago with a whole section on this, on are banks really constrained at all in how much money they can create. And the Bank of England actually confirmed that when a bank creates money to issue a loan, they don't even need to pay any attention to what reserves are at the Bank of England. The Bank of England will simply create those new reserves and accommodate however much money has been created by that bank. So in fact, some of the terms that are used in the literature for different types of money, especially for this type of bank-created money, so endogenous money, inside money as opposed to outside money, or perhaps most interestingly, horizontal money versus vertical money. Now that may sound pretty strange to you who are not familiar with this, to describe money as horizontal money. What does that mean? Well, it's to do with the shape of the supply curve of money. So if something has a steep supply curve, it means you cannot increase supply if demand goes up. So the classic example would be gold, for instance. If the demand goes up, it's very difficult to create new gold, to dig new gold out of the ground. But also many other products in a market are like that. So antique furniture has a vertical supply curve. You can't create any more 100-year-old furniture, for instance. So when people talk about bank-created money as being horizontal money, what they mean is the supply curve is horizontal, so there are no constraints whatsoever on how much money can be created by banks. So in Britain, around 90%, 97% of all of the money in the economy was created by banks. And of course, the vast majority of the population, either in the form of mortgages or other debt, will spend their lives paying interest on this money that banks simply create out of nothing. But there's another issue here then, which is, of course, in the boom times, in the good times, banks will create more and more money. That will boost asset prices. People will then borrow more money on the back of their house price going up. So more money is created by banks. But when the credit crunch hits, when people default on their debts, or also when debt is paid down, money is actually destroyed. So in this current system that we have, money can be destroyed just as easily as it's created by banks when they make loans. So this is what we call a pro-cyclical system. So it's highly unstable. So that it can be highly deadly both during the boom time when it feeds off itself and gets into a feedback loop, and when the credit crunch hits and you go all the way back down as well. So that's how the current system works, which even many economists, bankers, and even central bankers have found quite surprising. But you can see those interviews that I mentioned at the Cobden Center. So on then to the second part of my talk, which is some of the consequences of this that we're now seeing. And there are a couple of thinkers I'm going to refer to who will be useful today. The first one is Richard Cantillon, who was an 18th century French economist. And the second is Friedrich von Hayek, who was a 20th century Austrian economist. But we'll start with Hayek. So one of Friedrich von Hayek's core ideas was that interest rates are a pricing mechanism that should be set by the market, just like other prices in the economy. So here in Latin America, people are very familiar with the consequences of having governments set prices in the economy, especially next door in Venezuela. So when the government sets the price of food or fuel or consumer goods, we can all predict what the consequences are going to be. But Hayek argued that the same is the case when central banks set interest rates. So when central banks set interest rates artificially low, it creates debt bubbles, it creates distortions, and there's also, as we'll see, a number of other effects. So this current system that we have, this combination of banks being able to create essentially unlimited money out of thin air in the form of new loans, and also central banks setting interest rates lower and lower, that has served as the engine and the fuel for the creation of the massive global debt bubble that we're now in. And over the last few months, we've just started to see the first parts of the disintegration take place. But actually, this debt bubble has been building over the last 40 years or so now. So if we think about starting in the early 1980s, interest rates were historically high. And as they normalized through the 80s, that initiated a number of asset bubbles in America and elsewhere, in housing and some other sectors. But if you think about America in particular, when those bubbles burst in the late 80s, the response from Alan Greenspan in the early 90s was to set interest rates at 3%, the lowest for generations. And that then, combined with the Greenspan put, initiated an even larger bubble, the dot-com bubble. But actually during the 90s, there were a number of other bubbles in America in housing, and also a lot of the artificially cheap credit was exported both to the East Asian economies and also to Latin America. Then when the dot-com bubble burst in 2000, the response from Alan Greenspan was even lower interest rates of 1%, which created a yet larger bubble, the housing bubble. Then when that burst in 2000, the response from the Federal Reserve, this time from Ben Bernanke, was even lower interest rates still. In fact, well over a decade of 0% interest rates, the lowest interest rates in history. And that has created a far, far larger debt bubble. So in fact, in 2007, total aggregate debt worldwide, that is household debt plus corporate debt plus government debt, was around $150 trillion. And that was already by some margin the largest debt bubble in history in 2007. But since then, after years of 0% interest rates, that peaked at around $300 trillion worldwide of aggregate debt. So central banks responded to the debt bubble of 2007 by essentially doubling the size of that debt bubble. And that's what we're now starting to see disintegrating, with these banks going under, with pension funds blowing up, and so on. So now I'm going to move on to the second thinker I mentioned who's relevant for us today, which is Richard Cantillon. And as I mentioned, he was a French economist in the 18th century, well known for his eponymous Cantillon effect. And what that essentially states is that when new money is created, the people who receive that new money benefit disproportionately from that. So in the days of Cantillon, it was the French royal court, those surrounding the king. So when new money was created, those around the French royal court would receive that new money first. They would then go and spend that money into the economy, or they would invest in assets. And as that new money flowed around the economy, prices would go up and asset values would go up. And of course, those who had received that new money first would benefit from this. But if we think about our current monetary system, especially during the last few years of very loose monetary policy, the people who have benefited most, the modern equivalent of the French royal court, very wealthy hedge fund managers and others who can leverage up massively to gain outsized profits. But also, I mean, if we think in particular in Europe for a moment, then the ECB actually set negative interest rates for some time. And now, of course, that doesn't mean that you or I get to borrow money at negative interest rates, but it does mean that large corporations do. Now, another consequence of this then, other than the gross inequality that has built up, is also the level of malinvestment that has taken place. So again, if you think about a large corporation issuing negative interest rate bonds, so even if it does nothing to pay down the principal, for sake of argument, the interest will just reduce and reduce and reduce. So think how nice that would be to be able to get a mortgage with a negative interest rate. What that really does is it's led to a historically unprecedented increase in zombie companies and other signs of malinvestment across Europe. Because think about a large corporation that can just live off negative interest rate debt. It really doesn't need to innovate. It really doesn't need to do anything. So malinvestment has become absolutely chronic. But another consequence that I talked about in the book that I wrote with Steve Baker last year is bond portfolios. And now that's just beginning to show itself. So last year in Britain, during the brief premiership of Liz Truss, we had a blow up in the pension system from so-called liability-driven investments. But that's really just the tip of the iceberg in terms of the risk that has built up in pension funds and other bond portfolios as a result of this massive debt bubble that has formed during 0% interest rates. And so, to conclude then, a few points that are important to understand as this financial instability will get worse in the coming years. The first one is the nature of money creation, how banks create money. When a bank makes a loan, it does not lend out depositors' money as such. It simply creates new money, and you then pay interest on that money that was created out of thin air. Second of all, it's important to understand Hayek's idea that interest rates are a pricing mechanism. For the last 40 years, we've seen central banks responding to each recession with lower and lower interest rates, creating larger and larger debt bubbles. But also Richard Cantillon's idea that when new money is created, the people who receive that new money benefit disproportionately from that. And we've certainly seen a lot of that over the last few years. So thank you very much, everybody.